Hello and welcome to Macrobytes, the economics and politics podcast from Aberdeen. My name is Luke Bartholomew, and today we are talking about the long-term drivers of interest rates. And this is a discussion that gets at the heart of a number of extremely important debates in markets and the economy at the moment, including just how tight monetary policy is, how much downward pressure it's exerting on the economy, but also where interest rates might settle once we're past this current period of concerns about recession and inflation. So I'm delighted to say I am joined by two fantastic guests to discuss this topic. First, our very own Bob Gilhooly, who's Senior Emerging Market Economist at Aberdeen and has recently done some research on the drivers of long-term interest rates. So Bob, welcome to the podcast.
Hi, everyone.
And also by Lukasz Rachel, who is the Assistant Professor of Economics at UCL, University College London. He has previously had visiting positions at Princeton and Harvard universities, and before his time in academia, he had a distinguished career at the Bank of England, and he's produced extensive research in the past around drivers of long-term growth, long-term interest rates, and the optimal policy regime, with various co-authors, including Larry Summers. So Lukasz, thanks so much for joining us today.
Thanks, great to be with you.
Okay, so when economists talk about the drivers of long-term interest rates, they often have in mind this concept typically referred to as R star, or the equilibrium rate of interest, or the neutral rate, or the natural rate. And I think it might be possible to drive some distinctions between those concepts if you really want to, but generally speaking, they are used interchangeably, and that's certainly the spirit that we'll be using them today. And the idea of R star is that it's the rate of interest that over the long run would balance desired savings with desired investment, or put a slightly different way, it's the level of interest rates which would keep inflation stable over the long run. So it is a concept that's deeply bound up with ideas of balance and stability in the economy. It's a pretty slow-moving idea, but it does shift over time due to anything that shifts desired savings or investments. And it's important to distinguish it between policy interest rates, which of course can move quite a lot, indeed very rapidly, as we've experienced recently due to changes in the growth and inflation environment, whereas R star is much slower. And indeed, we can only really tell the stance of policy, how tight or accommodative monetary policy is, by comparing policy interest rates to this equilibrium concept. So policy is tight only insofar as interest rates are above R star, and it's accommodative only insofar as interest rates are below R star. And there's been a lot of discussion recently about how things that occurred during the pandemic may have fundamentally changed the drivers of long-term interest rates, meant that R star is going to be higher than it was previously. That has important implications for where market interest rates and other financial market variables will settle over time. But before we get to those things, I think it might be worth taking a step back and setting the scene on the developments and drivers of R star before the pandemic. And Lukasz, you did some seminal work back in 2015 on the drivers of global interest rates and the key themes. So could you talk us through that work, please?
Yes, absolutely. So, the key motivating fact that motivated a lot of the work that I and many others have done pre-pandemic on this issue is that the real interest rates that we observe in the markets, the long-term real interest rates, have trended down, continuously for the past 3 or 4 decades. And understanding this trend is really important from both a positive and from a policy perspective. So, we want to think about what does this trend tell us about the underlying forces in the economy, and then also what the policy implications are. And in the work that I and many other macroeconomists have done in the run-up to the pandemic, we kind of view this long-term real interest rates as essentially a price that equilibrates the asset market in the economy. What it really means is that there's some interest rate at which the desire to save in the economy is sort of met or balanced with the desire to invest. And so we can think about this longer term asset market as being equilibrated by this neutral rate of interest. And through this lens, we can then think about the changes to the equilibrium natural real interest rate as resulting from forces that potentially shift both the desire to save as well as the desire to invest. And indeed, in one of the first studies that I have done on this topic, we've looked at this empirical regularity that while the interest rates that we observe in the market have trended down, the investment and saving ratios to GDP have not really moved much in advanced economies as a whole. And so one conclusion that sort of comes out of thinking about this in this setting is that perhaps both the desire to save and the desire to invest have shifted in such a way to leave the equilibrium quantities relatively unchanged, and at the same time causing the real interest rate to slowly decline over time. So what might be these drivers of desire to save and desire to invest? Well, one primary driver is the growth rate of the economy. So when people expect their incomes to be high in the future, when people expect high growth, they tend to save little today because the times ahead are very rosy. And vice versa, when people expect slower growth, they tend to save more for those times that are not so good ahead. Similarly, investment is very much dependent on the expected pace of growth. And in fact, in advanced economies as a whole, these growth rates, when we take sort of moving averages or some trend measures of these growth rates, they have declined quite substantially, especially in the 1980s. So 1960s and 70s had really strong growth of productivity in advanced economies, and then we saw this big decline. And one, relatively uncontroversial reason for why interest rates have declined is this decline in productivity growth. And recently, productivity growth has also been quite weak, sort of keeping the neutral real rates low. The other reason is the demographic change that occurs in our economies. So as populations age, people tend to save more for their retirement because they expect to be in retirement for longer. And that together with that comes also a fall in the population numbers. So desire to invest is lower because there's going to be lower workforce, and therefore less capital will be needed to satisfy the production needs of the economy. So the demographics was another reason, quantitatively kind of judged to be on par with the declining productivity growth that has contributed to this trend. And then finally, let me just wrap up with some kind of couple of other trends. So rising inequality has often been discussed in this context because the evidence shows that wealthy and rich people tend to save more than the poor. So more unequal wealth and income distribution leads to higher saving in the aggregate. There's also been a lot of work done documenting the increasing spread between the safe interest rate, the one that we're discussing today, and the return to productive assets. And that increasing spread could have been the function of increasing financial frictions or difficulties in financial intermediation sector post-global financial crisis. And that in and of itself could have pushed the safe real interest rate down. I should also flag that there's some other trends that contributed to interest rates going up, at least according to the models and the theory that we have. So, increasing government debt to GDP ratios or increasing social security spending over time have contributed to higher real interest rates, simply because some of these increases they work basically to offset some of these, for example, demographic factors that are happening on a sort of private sector side. And this balance between public sector and private sector forces is something that we have highlighted in the paper with Larry Summers that you mentioned in the intro.
So Lukasz, when you mentioned those motivating facts for the work, it was talking of falling global interest rates since about the 1980s. And what's quite striking, of course, is that the 1980s is also a period of quite significant financial globalization where capital markets became much more integrated. So I'm wondering why R-star is best thought of as a global concept, and to try and make a distinction which is hopefully not too fine. I'm wondering if the way to think of this is that there are these drivers that play out at a global level, and then that just gets through capital market integration felt in every market, or it's more that there are lots of individual domestic markets that just also happen to be driven by a common set of factors at the same time. So it's co-movement rather than necessarily co-determination.
Yeah, that's a great question. And I think essentially the short answer is it's a bit of both. So there's certainly some common drivers across advanced economies that are playing out similarly in many countries. So productivity growth has declined in several economies. There's of course some differences within this dimension. So in the United States, for example, productivity growth has been stronger in the late 90s and early 2000s. But ultimately, the broad trend is quite similar. Demographic factors are also relatively similar. I mean, Japan is way ahead of other countries, and the US is a little bit further behind. But again, broad trends are fairly similar. The idiosyncratic differences within countries are then, washed out to the extent, as you said, that the global financial markets are integrated. So, in the world of perfect integration of global financial markets, we would only observe one global real interest rate, and the impact of these differential trends in each of these economies would only show up in the quantities, i.e. in the current account surpluses or deficits, and in the net foreign asset positions. In other words, there'll be one common global rate, and at that rate, some countries will find it optimal to borrow, and some countries will find it optimal to lend, depending on whether their sort of autarkic or closed economy hypothetical R star would be higher or lower than this common global component. And I think in the run-up to the global financial crisis, the global financial integration has progressed quite a lot, and we have seen a very strong co-movement across countries in terms of long-term real interest rates. There has been a little bit more dispersion since the global financial crisis and in the run-up to the pandemic, although the common trend is still very visible. Overall, this integration is much sort of deeper than in the 60s and 70s, and so we would expect this trend to be quite persistent unless there's some very strong kind of financial decoupling, which I don't think we would expect at this point.
So just to confront a question that some of our listeners might be thinking about when we've described this concept as unobservable, how is it that we might be measuring this unobservable thing that we're talking about? One of the deputy governors at the Bank of England, Ben Broadbent, likes to say sometimes, and I think he's quoting another economist, that R star is a bit like faith in the sense that you might be able to see it by its works, but you can't observe it directly. So how is it that we might go about measuring and getting at this concept of R star? So
absolutely, this is an unobservable concept, and sometimes there are these voices. I don't think Ben's is one here actually, but sometimes people say, well, can you really set policy based on something that is unobservable? Is it? So before we get to the measurement challenges, I wanted to confront that criticism because it's interesting. I think ultimately we must set policy on the basis of unobservables. I mean, at the end of the day, even in a simple product market equilibrium with the supply curve and the demand curve, these curves are unobservable, and we only observe equilibrium outcomes of quantity and price. But if we want to understand the market, we really need to estimate or figure out what the slopes of the supply and the demand curves are in order to carry out any kind of policy intervention. Similarly, at the macro level, the central bank must think about not just what GDP numbers that the ONS produces are, but also what they imply for the output gap, which is an unobservable quantity because we do not observe the potential supply of the economy. But it's very important for the central bank to get at that in order to predict what the ONS's numbers actually mean for inflation down the line. So there's no escaping that policymaking requires thinking about models and estimating unobservable quantities. Now the question is whether R star is, how do we estimate it, and whether it is difficult or not to do so. And I should say that it is a difficult concept in the sense that the error bands around any estimates of R star that we have are very large. And so our confidence around any specific estimate should be, we should use many models, we should use many approaches in order to get at the most robust sort of answer to this question of where R star is. But I think the broad sense of, having interest rates on average in real terms being around 4% 25 years ago or so, and the economy doing relatively fine, and then having real interest rates basically close to zero or negative, in fact, in the run up to the pandemic, and the economy not doing so great. That sort of juxtaposition of variables does give us a strong hint that that something fundamentally has changed in the economy. And in terms of how we go about estimating those quantities, there are some econometric models which basically take the data that I just mentioned and try to uncover these unobservable components using some filtering techniques. So that's kind of one class of models that one can use. The other class of models that one can use is write down a structural model of the economy where there's households and firms and government, and these agents take optimal decisions, and we can then think about what is their desire to save, what is their desire to invest, given these underlying structural changes in the economy, like demographics or changing productivity growth. I think those are the two broad classes of models that people use to get at this concept.
So, Bob, I think this will be a good time to bring you into the conversation, because in the same way that the fall in real interest rates combined with a period of economic weakness pre-pandemic was prima facie evidence, in the way Lukasz described it there, of R star having fallen, you might say that the big increase in inflation during the pandemic, at a time where interest rates stay extremely low, is prima facie evidence that R star increased significantly, and without policy rates going up, that meant that policy got significantly easier, and that's what allowed inflation to become so high. Now, the New York Fed used to publish, and I think has just started publishing again, its measure of R star, but famously it stopped doing so during the pandemic because it was going a bit haywire. But you have managed to reconstruct what you think might have occurred to R star during that period. So can you talk us through what your research suggests R star was doing and why it might have been doing so during the pandemic?
Yeah, I mean, thanks, Luke. I'll try not to go kind of too techy on this one. I don't think people necessarily want to hear the minutiae details, but effectively kind of altering the Holston Lowback Williams model to try to kind of create a short run measure of real equilibrium interest rates. For the US, this shows R star, in my estimates, rising from around about zero pre-pandemic to about 2% by the start of 2021, whereas of course the Fed was on hold until early 2022. So I think this sudden gap, at least in retrospect, helps explain why inflation might have kind of got so out of control. Now, of course, this is not easy to consider in real time, but one I think can point to a kind of combination of factors which could explain why R star got pushed so sharply higher by the pandemic. Most of this, I think, boils down to kind of policy stimulus hitting into and then amplifying pandemic-induced supply damage. So restrictions designed to protect the population from COVID simultaneously kind of damaged supply, curtailed the opportunity to consume services. You can't go out and do that when you're kind of locked in your house. At the same time, fiscal transfers reinforced household balance sheets, particularly in the US, contributed to labour shortages, and then this all added pressure to supply chains as consumption pivoted quite sharply away from services and towards goods. Potentially even, pressures could have been made worse by maybe, the desire to consume might have actually been kind of rising over this period. A sort of you only live once shock, if you will, through the discount rate might have kind of been brought about by everyone kind of being forced a little bit to reckon with their own mortality and health prospects. And then, finally, I think you'd also appeal here to, monetary policy reaction being a contributing factor too. The Fed's flexible average inflation targeting framework, FATE, was itself born out of a kind of world of low R star that existed pre-pandemic, and there was this kind of world of subpar inflation following on from the global financial crisis. You add that to kind of risk management considerations in central banking, which tends to lean policymakers maybe towards more slowly withdrawing support, and you kind of set the stage, if you will, for a policy mistake. So, in that sense, while fiscal might be kind of setting the stage here, the Fed not taking away the punch bowl as the most acute phase of the pandemic passed, I think probably also contributed actually to the short run measure of R star getting pushed higher, thereby kind of letting inflation out of the bottle as the kind of policy rates only moved up with quite a large delay.
So one striking feature of the US economy, at least over the last few months, is just how resilient it has been to higher interest rates. So it could very well be on this argument that R star is in fact much higher, and so this increase in interest rates we've seen isn't nearly as significant a tightening in monetary policy as we might think, and that's just why the economy has been as strong as it has been. So how convincing do you find that argument? Is it possible that R star is even higher than your current estimates suggest?
I mean, potentially, yes. R star estimates are very uncertain, as Lukasz was saying. This is a bit of a peril of kind of dealing with ultimately the unobservable. Some people have actually been pointing to the 10-year yield in the US as a signal that the market actually believes that R star might have shifted up kind of more permanently higher. There's actually some kind of technical market reasons as to why we might doubt that signal. I think there's also some questions about whether the kind of factors that you'd think about kind of pinning down the long run, which you typically think of as being slow moving, could have kind of suddenly jumped. And at the same time, I think maybe there's some reasons to think that actually these short run pandemic dynamics, as I described them, are actually maybe in the process of, if not fully reversing, at least fading. Global supply chains have pretty much fully recovered. Excess savings in the US seem to be falling alongside some improvement in labor supply, so that buffer to consume is falling. Core might not yet be target consistent, but it has eased very notably with kind of little economic pain. So, appealing to a kind of fundamental change inflation generation process, which keeps R star really high, might be pretty tough. So yes, there's some risk of R star being higher, but I'd actually kind of maybe frame it as having reasons to think it could be falling back, even if we're kind of unsure about where the ultimate level is. For what it's worth, our estimates of short run R star have actually fallen back somewhat since 2021, down about a percentage point over the course of 2022. So I think we can actually square the circle though here in terms of kind of why so resilient if R star might have actually been easing, which would imply policies actually getting tighter. And I think that would be to consider the timing, not in terms of when the Fed started actually hiking rates, but how policy rates then compared to their equilibrium counterpart. So, one narrative here is that 500 basis points of Fed hikes must have already been absorbed, hence the US can have a soft landing, or even, as some people have been saying, a no landing. But if you think of this in the term of when the clock starts and when actually monetary policy becomes tight, well, in our setup, this only actually happened in the sort of second half of 2022 when the FOMC had pushed its policy rates in real terms above R star. So that kind of timing effect could help explain maybe why the economy's actually been so resilient, implying that this kind of long and variable transmission mechanism that we often talk about in monetary policy is kind of still working its way through the system. And maybe also just giving a different reason on why the Fed is kind of seemingly happy to kind of sit with rates where they are.
And then looking beyond the discussion of, as you called it, short-term R star there's been a lot of discussion about where interest rates might settle in the long run, and in particular, an idea that's talked about a lot at the moment is that shifts in demographics might mean that equilibrium interest rates are going to be much higher. Lukasz talks about how demographics were an important factor in pushing R star down for much of the previous 30 years, but the thought is perhaps the sign on that might have flipped, that aging populations are involved in a lot of saving, and that helps to put downward pressure on R star. But old populations, which is where we are at a global level, tend to dissay. They run down the savings that they've accumulated during their working life when they were aging. And as such, desired savings fall significantly, and that puts upward pressure on R star. So you've done some work looking specifically at the demographic drivers of equilibrium interest rates. Do you find this argument at all convincing?
No, not really. To be honest, look, there's a few things to unpack on this one. So you should probably and give it a bit less of a flippant answer. And, demographics I think is a really interesting one. As both you and Lucas mentioned, there's the kind of savings aspect, and then also R star is closely related to the potential growth rate of the economy. So demographics is effectively affecting both aspects, given the shifting population implications, if you will, for kind of savings investment side. If I simplify a bit here, while the number of workers is like a direct input into potential growth. So we really need to consider like how the balance of these two effects works, how they could potentially be operating over different timescales too. So we found that actually demographics was pretty important in driving R star down before the pandemic, but we don't really subscribe to this argument that it is kind of radically shifted, the sign is flipped, or indeed that it's necessarily even going to push R star much higher over the next 7 to 10 years. Good news in this kind of relative sea of uncertainty is demographic trends over the next 10 years or so are actually relatively firmly set, reflecting past trends in fertility. So we can actually have, like I say, within economics, reasonable confidence on the outlook for population. We can use that to help inform our view of potential growth via the implications for the workforce too. So, after modeling both the global growth outlook and then thinking about how demographic composition might be affecting savings and investment balance, we can effectively kind of put this all together to consider how those net balances could play out. We find that the negative impact from potential growth wins out in the end. Even in the case of Japan, actually, which is well known for its aging population, we estimate that a more adverse demographic backdrop is still likely to be putting modest downward pressure on R star. It's actually only much later, beyond 2035 or so, that these kind of indirect aging effects we think are kind of sufficiently strong to necessarily push R star higher. Now, for some countries such as China and Thailand, we do think there's going to have some more upward pressure from demographics and R star earlier on. These countries got very adverse moves in dependency ratios and aging speeds. Those are very pronounced, such that the compositional effect can dominate the labour force effect via potential growth. But even then, we actually think that kind of other weakening drivers of potential growth, such as productivity and capital deepening for China, will still kind of, on the whole, more than offset this. And since we actually find little upward pressure on R star for the major economies, and then we build in this mechanism which allows kind of R star to percolate through the global financial system, we find this global channel should be kind of helping to offset upward pressure from demographics from where it does emerge.
So, Lukasz, bringing you into the conversation, again, I'm interested in where you think R star might settle, and just to expand the list of potential drivers on R star and those that are often invoked as ideas as to why it might have moved higher. People talk about changing patterns of globalisation, perhaps fiscal policy has become more active in demand stabilisation, and combined with a more active state in investing in green technologies or for other geopolitical reasons means sustainably higher debt to GDP ratio, or perhaps AI is going to cause a big increase in potential growth and demand for capital and investment as a consequence of that. So to ask you the same question I asked Bob, do you find any of that convincing?
So first maybe let me start by going back to the demographic story that Bob just outlined very nicely. I just wanted to say that I absolutely agree. There's this element of change in terms of the direct effect of the saving propensity of the older population, but that is very much in the models that we have of this is very much balanced out by basically smaller workforce and slower potential growth. So I very much agree that there is no sudden turnaround around the corner coming from demographics, at least in the scenarios that I have studied. Now, in terms of the other factors. So absolutely, there's been some big changes in the last few years in the global economy. So one massive change was, of course, the rise in government debt to GDP ratios during the pandemic. And the question is, what that will mean for R star. This increase looked a lot bigger a couple of years ago, though, because the last 2 years of inflation have essentially meant that these government debt to GDP ratios across the OECD have declined substantially. And so, that increase in government debt to GDP ratios is probably not as large as we might have thought, and, could add perhaps maybe 20 or 30 basis points to advanced economy R star over the next few years. But that is nothing that it would be, reversing this very long run trend. Although I must say that in the US, at least, the government deficit appears to have ballooned this year. I think it's about 2 trillion right now, what people estimate for this fiscal year. And so it remains to be seen like how much more the debt grows basically over the near future. And that's I think something to watch. The other thing that has potentially changed is the attitude towards public investment and industrial policy, particularly in the US, but perhaps maybe also some other countries. There are some early analysis or early estimates of the macroeconomic impact of these policies, and they suggest large impacts on specific investment within specific areas like clean energy or semiconductors. But once one brings these numbers to the whole macroeconomy, the numbers look relatively contained. But I think that this area definitely looks to me like it could be the source of upside risk. The reason why it's so hard to assess this with any certainty is that we haven't seen this kind of policies for a very long time, if ever. And so it's very difficult to judge how much of crowding in of private investment the public initiatives will bring. One thing that might be offsetting the impact of the higher investment on R star is that as technology progresses within, say, the green sector, this investment is also going to become cheaper over time. And cheaper capital goods have also been one contributing factor to low rates. We basically don't need that much saving to finance investment because investment goods are becoming cheaper over time. And so that's a useful offset to think about. And then finally, you mentioned, AI type of innovations. And I think that's another source of risk. The estimates of AI are extremely uncertain at this point. And as far as I can tell, they basically cover almost the universe of numbers between essentially 0 to kind of 3 or 4% impact on productivity growth every year. So obviously, if you think that AI could boost productivity by several percentage points per year, then we're in a very different ballgame altogether in terms of macroeconomic outlook, and R star will be affected as well. But we should also remember the other side of the story. So the revolution that comes with AI might come with a lot of uncertainty for individual firms, for individual people. That could spur some precautionary saving. And perhaps we might be worried about what the balance of market power is going to look like after these technologies settle in our economy. And that's sort of market power issues that I think we have, especially in the US, struggled with over the past 20 years or so. They could also play an important role and possibly, depress returns on these safe assets further. So I think overall, like taking it all together, when I, run my models and my analysis, what I tend to think is that the market observed real interest rates just in the run up to the pandemic, so say from 2017 to 2020, have declined a little bit below what we can account for in terms of these structural models. And so the recent correction in the market sort of brings us closer in line with what the structural models can predict based on these different factors that we have discussed. So I'm not seeing any rapid turnaround from any of these specific factors, albeit there are definitely some upside risks out there. Instead, what I think might have happened is that the market might have overshot before the pandemic and corrected now to roughly the level which we can kind of justify or account for with some of these structural approaches.
And then finally, Lukasz, I just want to touch on the interrelationship between R star and monetary policy regime. So less the question of interest rates right now, but sort of the appropriate context for setting interest rates and the target that monetary policy should be trying to achieve. Because there was a very popular idea pre-pandemic that if R star was going to be extremely low, that meant that policy interest rates on average would be very low. And so when a negative shock came along, it would be very easy for interest rates to find themselves stuck at the effective lower bound. There wouldn't be much space to cut before they got to something like zero and then couldn't be pushed any lower. And that would lead to monetary policy being on average not accommodative enough. And so therefore perhaps we needed a policy regime that favoured higher inflation target or had some sort of memory in the system that required catch up, or a different kind of fiscal monetary policy mix. So given the developments since the pandemic, both around R star, but I guess around inflation too, how do you assess those arguments now?
So given my assessment of where long-term R star is ultimately going to settle, I think a lot of these arguments sort of still make sense. So to the extent that R star settles at around 0.5 or 1% in real terms in the longer run, that is, in my opinion, still uncomfortably close to the zero lower bound. And I think the costs of hitting the zero lower bound are substantial. And so I think it would be worth to revisit the debate about the appropriate inflation target in the longer run. This is probably not the debate to have right now, given that we are clearly not at steady state at the moment, and we have to worry about bringing inflation back to target. But I think that is something to think about going forward. Of course, if real interest rates will settle at a higher rate, that will make fiscal policy more expensive, and in particular, the fiscal sustainability picture is, of course, very much complicated by higher real rates. And policymakers should worry about the fact that, on the one hand, aging populations will exert a pressure on spending through social security programs. At the same time, the tax base is going to be getting smaller, and all at the same time, it could be that R star is higher and debt is rising, even if we don't have any deficit, even if we run a balanced budget. And that's what will happen if R is greater than G. So I think that is definitely one risk that policymakers should think about in the longer term. But for the moment, I think about it as a risk, and my central expectation is that still, hopefully, G is going to be greater than R in the long term once the post-pandemic dust settles.
And that is all we have time for this week. So as ever, please do subscribe and rate us on your podcast platform of choice. And then all that remains is for me to thank Bob and Lukasz for joining us today and their fantastic contributions, and to thank you all for listening. So thanks very much, and speak again soon.
This podcast is provided for general information only and assumes a certain level of knowledge of financial markets. It is provided for information purposes only and should not be considered as an offer, investment, recommendation, or solicitation to deal in any of the investments or products mentioned herein, and does not constitute investment research. The views in this podcast are those of the contributors at the time of publication and do not necessarily reflect those of Aberdeen. The value of investments and the income from them can go down as well as up, and investors may get back less than the amount invested. Past performance is not a guide to future returns, return projections, or estimates, and provide no guarantee of future results.